Welcome to the Deep Dive. We're here to take a stack of complex financial and geopolitical intelligence and distill it into the knowledge you need. Today we are witnessing a complete overlap. Massive geopolitical decisions are not just affecting headlines, they are driving commodity prices, forcing central banks to rethink their timelines, and directly hitting corporate earnings across the globe.
That's right.
If there's one theme connecting every piece of data we're seeing, it's that systemic political friction is now the primary driver of market volatility. We have sources covering the sharp escalation in energy sanctions, the critical tightrope each of central banks are walking, and some, well, surprising weakness in key corporate behemoths like Tesla and IBM.
Exactly. Our mission today is really to cut through the noise and show you how these seemingly isolated events, sanctions in the Atlantic, wage battles in Tokyo, tariff hits in Texas, how they're all connected. We are tracking a sudden and frankly significant shift in the global risk landscape, and we need to understand what that means for capital flows right now.
Okay, let's start with the most dramatic, immediate market mover, the sharp escalation in US and EU policy targeting Russia. We are seeing sanctions hit major Russian oil producers, specifically Rosneft and Lukoil. This wasn't just some incremental policy change. This was a sudden U-turn that immediately shocked the energy complex.
Yeah, what is fascinating here is the sheer speed of the reaction. Brent crude futures surged towards $65 per barrel, and WTI neared $61, almost instantly. And the significance of this move isn't just the price jump, but the operational disruption it's causing.
How so?
Well, major buyers like India are reportedly being forced to reconsider their Russian crude purchases. We're hearing they might have to reduce them to near zero.
Near zero? Wow, why?
Specifically because they risk losing access to the vital U.S. banking system. This isn't really about market mechanics anymore, it's about regulatory fear, pure and simple.
Right. And the pressure is being reinforced by the EU's 19th sanction package. That includes a future ban on LNG imports starting in 2027.
Right.
And critically, it targets 118 vessels in Russia's notorious shadow fleet. Those are the aging, often uninsured tankers used specifically to sneak oil past existing caps and oversight.
Yes, it's an explicit move to choke the logistics, cut off the transport. And this kind of geopolitical pressure, well, it immediately shifts the dynamics in other sensitive areas too. So simultaneously, we see trade tensions widening between the U.S. and China. The U.S. is mulling export restrictions on critical software to Beijing,
Which China sees as direct retaliation for its own controls on rare earth materials tit for tat.
Exactly. And that software restriction is a crucial pressure point the U.S. president will undoubtedly leverage when he meets with Xi Jinping next week.
Especially regarding China's continued purchases of Russian oil, right?
Yeah.
Heavily discounted, I imagine.
Precisely. It's all connected.
Okay, so that brings us directly to the sharp consequence of these global tensions landing squarely on manufacturing supply chains. The sources highlight that the global auto supply chain is under immediate threat. Nexperia, that's a major Dutch semiconductor firm owned by a Chinese company. They notified their key Japanese auto parts makers that ship deliveries might no longer be guaranteed because of potential export restrictions.
And when the Japanese Automobile Manufacturers Association calls this an immediate and serious concern, that tells you everything. This volatility has extended far beyond just crude oil. It's now threatening the heart of global production. It's serious.
These supply chain threats, whether we're talking oil or semiconductors, they fundamentally change the calculus for central banks in Asia. Let's shift our attention to Tokyo now, where the Bank of Japan is facing immense pressure over its rate policy.
Yeah, the question of when the Bank of Japan will raise rates again has shifted from, theoretical to immediate, front and center. While 90% of surveyed economists expect the BOJ to hold the policy rate in the October meeting, just wait. A near unanimous 98% expect a hike by January next year.
98% by January, that's almost certain.
And we are seeing the consensus for a December hike sharply increase. It's up to almost half of those surveyed now, so it feels like a matter of weeks, maybe months at most, before they lift off.
The sources suggest the delay is partly political, isn't it? With the new Takichi administration focusing on immediate price measures, and partly economic, with the BOJ needing to fully assess how U.S. tariff policy will impact the export sector. But the core economic reality is just painful.
Absolutely. Core CPI has been above the 2% target for 41 consecutive months. Think about that.
41 months, yet real wages
Have fallen for 8 straight months. That gap is causing intense social and political pressure. You can feel it building.
So how do they address that?
Well, to address that severe wage inflation gap, Rengo, Japan's largest labor union, has set a highly ambitious goal for the 2026 spring labor offensive. They're aiming for a total wage increase of 5% or more. Their long-term aim is to establish a norm of 1% sustained real wage growth.
5%. That's ambitious. But can companies even afford that?
That's the critical friction point for the BOJ. Corporate data shows that companies' average cost pass-through rate remains near historic lows. It was just 39.4% in July, so companies are effectively swallowing 60% of their cost increases. They simply cannot afford that 5% wage hike Ringo wants unless they finally gain pricing power.
Which would totally change Japan's inflation outlook, wouldn't it?
Dramatically, it's a real bind.
Okay, meanwhile, across the sea, South Korea's central bank also held its rate steady at 2.5%. And this is amidst intense, complex negotiations over that huge $350 billion U.S. investment pledge.
Right, and as seen in the provided information, the U.S. Secretary Bessent gets it. He understands South Korea can't just pay the full amount up front. That would cause real problems in the FX market. So negotiators are discussing structured annual payments, maybe around $20 billion a year.
Specifically to avoid destabilizing the won. It really emphasizes the need for the Bank of Korea to maintain stability during these massive international finance deals.
Exactly. Stability is key.
Okay, so now that we've covered the macro tightropes, we really need to understand the investor mood in the U.S. market following this surge of volatility. The CNN Fear and Greed Index is a key barometer here, right? It signals whether institutional money is running towards safety or embracing risk.
It is. The index tracks 7 core metrics, things like market momentum, the VIX volatility index, stock price breadth, to give us a picture of sentiment. Take the put-call ratio, for instance. It tells us how much hedging institutions are actually doing. Hedging risk.
And what's it saying now?
Well, even without the current headline score right in front of us, based on the input sources, the internal metrics signal deep wariness. We're seeing declining stocks, about 62.8%, significantly outnumbering advancing stocks at 33.8%.
So almost 2 decliners for every advancer.
Yeah, and over half of all stocks are trading below their 50-day moving average. That tells you investors are not confident in the immediate uptrend. They're cautious.
Corporate earnings certainly confirm this turbulence. Tesla shares slid after profit tumbled. What was it? A staggering 40% year over year?
40%. And that $400 million hit from U.S. tariffs absorbed alongside those ongoing price war pressures in the EV sector. It's a stunning, quantifiable demonstration of how geopolitical friction immediately impacts a company's balance sheet. Right there in black and white.
But it wasn't just Tesla. IBM shares fell 7% pre-market. That suggests something deeper than just tariffs, doesn't it? Is the AI competitive landscape shifting that quickly?
It really looks that way. The slowing momentum in IBM's key Red Hat Cloud and AI unit has clearly spooked investors. They're raising skepticism about their competitive position. So they aren't just fighting macro headwinds, it seems they might be losing ground in that crucial high-growth AI battle.
Which reminds us that internal execution failures or governance issues often amplify external risks.
Definitely.
And speaking of governance, we have to note the concerning development from Japan. NIDA canceled its interim dividend and share buyback, apparently due to ongoing improper accounting investigations. That's never good news.
No, a canceled dividend because of an internal accounting scandal chills market sentiment faster than almost any macro data point. It shows corporate confidence is being undermined right now, not just by external forces, but from within, too.
And that ties directly back to protectionism, doesn't it?
It does. We are seeing a major push for stricter national security screening of foreign capital in Japan. The government is planning to create a Japanese CFI-US.
Modeled on the U.S. system, the Committee on Foreign Investment in the United States.
Exactly, and investment experts are pretty clear. They see this explicitly as a proactive move to regulate Chinese capital inflows into Japan's strategic sectors. It's essentially about walling off parts of their economy from specific foreign investment.
Okay, before we wrap up, let's quickly look at the currency and credit markets. They're the direct receptors of all this central bank caution and global tension we've been talking about.
For sure. On the Forex front, USD-JPY is notably stronger, trading around 152.76. That renewed yen weakness is a direct reflection of the BOJ rate hike delay we discussed earlier. The market is pricing in that policy divergence. Simple as that.
And USD?
Sitting slightly lower at 1.1588. That reflects general US dollar strength, which is pretty typical when global risk-off positioning takes hold. People flock to the dollar.
Okay, turning to Europe. While overall corporate bond issuance is actually at a record pace this year, I think it surpassed 1.76 trillion euros. We just saw the first bond issuance cancellation since June. Norwegian firm CMB Tech pulled a $300 million offering, pulled it right off the table.
Yeah, and this is a critical signal, I think. Despite all that record liquidity flooding the market, investors are showing rising caution. They're starting to avoid the riskier issues. We're seeing corporate credit risk indicators rising actually to their highest level since June.
So pockets of stress are emerging, even in a market that, on the surface, appears pretty robust.
Exactly. Investors are becoming highly selective about who they fund. They're looking much harder at the underlying risk now. #outro.
Wow. We've covered a massive territory today, from surging oil and trade wars threatening chip supply to Japanese wage battles and cautious central banks trying to maintain stability amidst these global financing pressures. So what does this all mean? I mean, the market seems fundamentally redefined by this systemic political friction. Risk isn't just priced on balance sheets anymore, is it? It's priced on unpredictable political decisions, whether that's a sudden sanction U-turn or a new national security screening mechanism.
Absolutely. And this raises an important question for you, the listener, to consider. With global supply chains under such intense pressure from both sanctions and rising protectionism, hitting everything from oil logistics to critical software, how quickly will major multinational companies, like the Japanese automakers struggling with Nexperia, or tech giants like Tesla absorbing tariff hits, how quickly will they be forced to restructure their deeply ingrained global supply chains? And maybe more importantly, how much more expense and friction will that inevitable adjustment introduce to the trajectory of global economic growth?
That's definitely something to mull over. Thank you for joining us for this deep dive.